All right, so this is just a quick summary in terms of what all we learned in all the three segments of how to build your net worth and how to increase your income and how to build your assets. So first thing first is savings is the essential but not enough component for your wealth investing journey. So let expense is equal to income minus saving, and saving can be at least 5 to 25% of your income. Next, investing helps you grow your money and your savings. So investing helps you beat inflation. It's a must for wealth creation. It is okay to start small, but start early. Third very important thing is build asset, which is what will generate passive income and avoid debt traps for you. And finally, focus on building your net worth. What is net worth? Net worth is asset minus liabilities. Know this to track your true financial health. Many times, people have too many liabilities, although they think they have assets, but their net worth is actually not substantial. So please make sure that you are tracking this on a regular basis. And ultimately, your goal should be to at least achieve first level of financial independence, which is 25 times of your annual expenses should be your net worth. So these are top 5 points on what we learned in this segment of how to build net worth. And in the next video, we will be going deep in terms of how to understand your asset allocation, and that segment is again going to blow away your mind. So I'll see you in the next segment. All right, so hi, welcome to Kotak Stockshaala, and this is the second segment where we are going to learn about asset allocation. What are the key principles? Now, before even starting this video, I would like to tell you that this is just an indicative, factual information purpose video. You need to make sure that you consult your financial advisor to do it on the right way. I'm just giving you the broad guidelines. It might not be perfectly fit based on your personal circumstances. These are all generic data points and facts which I'm going to give you. But please make sure that when you do this exercise, when you actually want to move forward with this entire thing, you consult your financial advisor. This is not a substitute to your financial advisor who can guide you in a much better way. So, having said that, there are 4 different kind of asset class. A lot of people ask me, hey Vivek, I want to build asset, I want to buy appreciating assets. What is the formula to it? How to understand these asset allocation, and what should I do if I want to build assets? Now, you need to understand that each of the asset class have different purpose. So the first and most important thing which you need to do is security of your financial condition. So whatever money you have got, you need to make sure that you secure your lifestyle, you secure what you have achieved so far. And for security, there is something called as fixed income, where you get some kind of fixed income, whether it is directly or at the end of a tenure. But it is promised to you and it is fixed and there is no deviation from it. So that is called fixed income, which is generally in the form of debt instrument. So if you are putting money into FD, that is form of fixed income. If you are buying bonds, that is form of fixed income, where you get certain amount of money either regularly or at the end of the tenure. Even if you are working, if you are putting money into PF, Provident Fund, that is also form of fixed income. Even if you are putting money into PPF, you are investing as such in the fixed income asset class. So anything which gives you fixed returns without any much of the risk, which is generally called fixed income. Of course, anything in financial investment is a risk, but this is fairly secured instruments where you have promise to get that amount after a period of time. Now, the returns of debt, if you see on the slide, will be generally equal to inflation plus or minus around 2%, right? Sometimes it might be slightly lesser than inflation also, but generally you will have 1 or 2% higher than inflation. Now again, you need to understand here that fixed income is mostly for your financial security. So if you are putting money into debt, bonds, FD and so on and so forth, it is for your security but not for growing your money. So don't go overboard into it. At the same time, you need to understand the tax angle, that after tax, what is the returns that you are getting. So if you are in a higher tax bracket, sometimes rather than doing direct FD, you might want to do some kind of mutual funds where you can optimize on taxation, right? So consult your financial advisor for that. But please remember, debt or fixed income is only for your security, and also understand that there is a tax angle to it. The second very powerful instrument is called equities, which is also called shares. Now, why is it called shares? Because you are part owner of the business. So let's say you are owning Reliance share, and if there are 100 shares of Reliance, and if you own one share of it, which means you are a 1% partner of that company. Similarly, if the company has 1,000 shares, and if you are holding 100 shares of that company, which means you are a 10% shareholder or a partner in that company. So whatever profit they make, and if they distribute any kind of dividend after that, you get that percentage of dividend out of that entire chunk based on how many shares you hold. And same way, if there is a value increase of the shares, you can even sell it if it is a listed security. What I mean by listed security is if it is traded on BSE or NSE or any kind of stock exchanges. Now, what will be generally the mindset of equities? See, when you are buying equities, think like you are buying a business. And you know that all businesses are dynamic. Nobody knows future. So even businesses will not know what will happen to them in future. There could be changes in interest rates. There could be COVID that can come in. There could be changes in the economic condition of the country. There could be changes in the customer behavior. There could be competition. Anything can happen in future. So when you are actually buying shares or equities, you are actually buying different kind of businesses. Now, the best part of being an investor is that you don't need to just own one businesses. There are a range of businesses which are available, right from financial sector to consumption to transformer sector and whatnot. Okay, so you can buy from a range of more than 7,000 companies which are listed in India if you just focus on India, but you can also buy global shares, which opens up a whole new world. So that is what is equity. Now, you need to understand that equity doesn't move in one direction. It is volatile. It can have ups and downs because future is uncertain and there could be fluctuations in the economy as well as in the business also. There could be a lot of changes. Now, generally what we have observed is every year equities goes up or down by 10 to 20% easily. That is a kind of volatility. And every 5 years we have seen 30 to 60% decline also. Now, it is up to you whether you see this as an opportunity or you become fearful of that. It's part of the game. Equity will be volatile, but you need to understand sometimes it can be a great opportunity where you can buy these shares at a very good price also. What will be the returns of equities? Generally, over last many years, what we have observed is equities give you return of inflation plus GDP, which is nominal GDP. So around 12 to 13% roughly, which is the nominal GDP of India currently, is what you should broadly expect over a long term in equities. So you should have a right expectation, but the good part is it substantially increases your purchasing power, because if the GDP, the net GDP or real GDP is growing at 5 to 6% also, that is over and above inflation. So you are actually growing your money above inflation at a very good substantial rate. And that is why we are here in this Kotak Stockshaala, to understand why it is so important to buy stocks or shares in the share market and how that can be a great tool for increasing your wealth and increasing your income. The third very powerful instrument or asset class is gold, which again, has long cycles. It can decline 10-15% anytime. It is volatile, but it also protects you from rupee depreciation and inflation. So gold and real estate are good hedge of inflation. Now, whatever happens, I am a firm believer that we should have a broad diversification in the asset class. So some money should be parked in the fixed income, some money should be parked in equity, some money should be parked in your gold, and some money should be parked in real estate. It should not be this versus that, but you need to be broadly diversified based on your risk profile. so that anything happens in the world, you are still hedged overall, and still one or the other asset class is working in your favor. So last is real estate, which again grows at inflation plus 2 to 4%. Historically, that is what has happened, and it has long cycles. Like for 7 to 10 years it will keep growing, and for 7 to 10 years it might not grow at all, or it might grow much lesser. So that is what is the cycles of gold and real estate. These are the four asset classes which are available to you as an investor. What we will do is in the next video, we are going to understand what is the difference in terms of compounding for all these four asset classes. As an investor, what should be your thought process? And later on, we'll be also doing a risk profiling through ChatGPT to understand how risk profiling happens, what is the questionnaire, and then you can do the same sitting with your financial advisor and then going deep into that journey. So I'll see you in the next video where we are going to go deeper into all these asset classes. But hope you enjoyed this video. You got some powerful ideas from this. If you loved this, type in the comment below what were your key takeaways, and let's see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.